All right. And so Terrence, please feel free to take it over. Thank you for being with us today.
Solid. Thank you, Colton, for the introduction. Thank you all for attending, and definitely thank you to Governor State. Um, Excited to talk with you guys. It's something that I do day in and day out. As Colton said, I've worked for JP Morgan, was a banker there, started off my financial career, and then moved to be a financial advisor there, and then transitioned to Northwestern Mutual. And then actually, so I was at Chase for 7 years. I was at Northwestern Mutual for 3 years, and now I'm transitioning to US Bank as a financial advisor there. So continuing now, going on, well, it's 9 years, going on 10 years next year that I've been in the industry for. Um, for me, I always think about, well, what got me started in the financial industry? Um, First thing first was I just enjoyed math. One of those moments where just growing up, some of the subjects didn't really stick with you or click with you, and which ones that you enjoyed the most. And it was math. From there, you have your family telling you, oh, go accounting, try out finance work. But I tried accounting. When I got to managerial accounting, I realized that I didn't like it. And was blessed with the opportunity to understand just the dynamics of finance overall and how to actually just help guide people through it. That's what I look at financial planning as. So today, like Colton said, we're going to discuss some financial literacy, different ways of how to get started. One, what's some of the basics, right? Like what's some of the basics of financial literacy? What's the need for it? Also, two, the time value of money. I think that's really important. A lot of times people forget about how long that it actually takes. As we know, everything is a marathon, um, and that it takes patience. From there, also to discuss, like I said, some of the tools and the resources to get started. And then from there, just some of the behavioral finances that I come across with some of the clients that I come across with, just some of the people that I just educate along the way. And I know if anyone have any questions, definitely please jot them down, put them in the chat box so we can make sure that we address them at the end. I don't have like no big long talk or anything like that. So definitely want to make sure that we have some time to be interactive with one another, especially if there are some questions that's on your mind. All right. So I took a little notes here, because I know that sometimes I can kind of jump all around with talking and everything, especially some of my clients call me a nerd for this type of stuff. So forgive me if I go on a tangent a little bit, but I definitely will make sure that I bring it right back. So big thing is I always look at when you think about life overall, anything that we do, just like how we set out on a mission to complete school, set out on a mission to go after a career, we always want to be very intentional and an understanding of why we're doing what we're doing. So even when it comes to money and finance, right? Like it's the real life game of Monopoly, in other words. And in a sense, as we're making the money, it's not always about um, just fun spending. Of course, that's a part of it because I love to spend money. But in order to spend money, we want to make sure that we have the confidence to do so. So when we're thinking about, okay, well, what's the basics of it? We want to know as far as just the ins and out of money management, everything from budgeting, everything from making sure we're paying our bills on time, and as well as paying ourselves, and also to investing, making sure that we are putting our money to work just as hard as it was for us to get it. And then as well as making sure that we have some fun in there. I like the fun coupons, which I feel like who doesn't, right? So when we think about just making sure that we do have all the different tools, the different understanding of how to use those tools and use it efficiently. So then that way we're not being in the middle of that rat race. So when we think about finances and when you say, all right, well, why do I want to know about financial literacy? Like when I make the money, when I have the financial dollars, what do I want to do with it? And at the end of the day, we want to make sure that, hey, we are intentional about what our mission is behind while we're saving money. And as we learn in the financial literacy, that we actually are taking actions and steps towards it. So we have everything from, hey, I want to create that financial freedom, right? I want to make sure that I can just afford my everyday living. I want to provide for my family, if not start a family. And then also, too, just want to be able to buy back your time, which, in my opinion, is the most valuable piece of currency, is our time. And in order to sometimes get more of our own time and be able to dictate what we do with it, money is a great tool to help us do so. Because at the end of the day, when we think about just the tools and the basics of money, it takes the same amount of currency for the Feds to print $1 bill than it is to print $100 bill. So when it comes to that, I always like to say that to give a person an idea of, well, how do you view money? What do you want money to do for you? What do you want your life to look like for you long term? It's important to see yourself as who you are today, but then also to see yourself for who you want to be 5, 10, 15 years from now, let alone all the way out through your transition. And I mean, the world that we in is just that money allows us to do that. So when I think about budgeting, I always want to think about first, well, all right, think about the one great rule of thumb to make that really easy, because I know a lot of times it's kind of hard for people to think about where to start, is a 20-60-20 rule. And 20-60-20 basically means is 20% is the amount of income that you want to save towards any financial goals, anything of financial planning. And then 60% is anything that you want as far as like your day-to-day living. And the other 20% is everything that you will have fun with, that you are giving your discretion to yourself. Now, those numbers can change, of course, based on what a person's goals are. Maybe it's 30, 50, 20, or, whatever it may be based on whatever it is that you want to accomplish. Once setting that 20-60-20 or figuring out, all right, well, what is the 20% going towards? And that's why I always tell people it's always good to make sure that first we are very intentional of where we're going when it comes to your finances and your financial planning. Because as long as you know where you're heading, and as long as you know how much percentage of your money to save, you're going to ultimately get there. Even if there's bumps in the road, which we anticipate for it to be bumps in the road, and that's the reason why, financial planning is so important. I'll definitely make sure I share my contact information. And that's another reason why we must make sure that financial planning is so important, because, think about it when you're going to an unfamiliar place, like traveling, a restaurant that you want to check out, and you may not know exactly how to get there. You put it in your GPS because your GPS know different routes on how to make sure that you get to your destination. And I always look at financial planning the same way. Like, let's make sure that you have a destination to get to. And then from there, let's build out that route that we're going to go to get there. And regardless what may come in our way, traffic jam, little accident, whatever the case may be, the GPS is going to take us on another route, or we're going to stay on that same route and just, take a little bit more time to get there. But at the end of the day, we're going to get to that goal. And that's why I always tell people that when it comes to financial planning, first thing first is to think about what that long-term goal is for yourself. From there, once you have that long-term goal for yourself, backtrack into, okay, what is the percentage that I should be saving towards these goals? And a great rule of thumb to start off with is 20% of whatever your annual income is. And as you're bringing in that 20% of annual income, you can do it as far as, hey, 20% of your every check that you're bringing in every week or every 2 weeks or just every month, that then will equate ultimately to your 20% overall of saving your gross annual income. A lot of times what people are starting off, believe it or not, is their employer. That's one of the most easiest and simplest ways for you to save is through your employer. If your employers have the retirement benefits, that is, a lot of employers will give a match of like 3 to 5%, right? So, you save 3 to 5%. I always tell people, hey, at least get up to the match, right? We always hear, hey, it's free money, it's free money. Technically speaking, it's not free, but it's somewhat free. The only reason why I say it's not technically free because a lot of people don't know, but a 401k actually has fees inside of the 401k that you pay every time you're contributing to it, every time when you're buying different stocks within it, because it takes account managers just to manage the 401k and the funds that all the employers have. So the money that they're giving you, in a sense, look at it as that's helping you pay for some of the management fees inside of the 401k. So, I mean, it's money that you wouldn't have. So still free money, but I look at things a little bit more beyond surface level. And when you think about getting the match, so let's take 5%, for example. If your company match up to 5%, you're doing 5%, your company's doing 5%, that's technically you're doing 10% because 5 plus 5. Now, that extra 5, you don't want to include that into your 20% overall, but at the same sense, you still have an extra 5%. From there, then a person know that their retirement is already what they have in place. Next, outside of their retirement through your employer, another easier way that's even easier than your 401k is a savings account. Savings accounts is a lot of times overlooked, and especially in the generation that we're in now, because we know that the banks aren't paying anything when it comes to interest. But the savings account is important just because it's for the unforeseen emergencies that may pop up tomorrow, next week, next month, something that comes way sooner than 20 plus years out. So those two accounts right there, savings accounts, first and foremost to start off with, just because it's able to just to put rainy day funds away. If you're working and your employer has retirement benefits, get started with your 401k immediately as soon as possible, because then that's just going to allow you to get a match, put up some retirement money away for you. So outside of that, when it comes to investing, although you are investing in your 401k, and I always tell people like start off there first, because investing is more of a luxury than it is a necessity in a forefront. Because once you are saving for your retirement, and generally speaking, that is investing, from there, investing is a luxury. Because your retirement money that you're investing, generally speaking, you're not seeing it because it's being saved for you before you even get your direct deposit from your check, from your employer. So when you think about just extra ways of investing, like nowadays people are heavy into stock trading, which I'm not against. They have different things like Bitcoin. I'm not necessarily against that either. And then just different avenues of investing. But the reason why I always say that it's a luxury is because a lot of times in life we have other priorities before we take on that risk. And because we have these other priorities before taking on the risk of investing, because all your principal is at risk, the fluctuations of the ups and downs of the market, it's not a matter of if the market goes down, it's more like when. And if you're a person that likes to time the market, then you can be strategic when the market does go down to make sure that you're pulling out in the right time, or when something has gone down to make sure that you're jumping in at the right time. So I always look at anything investing outside of your retirement money is a luxury. Believe it or not, sometimes one thing that's even like for some clients is a little bit of a complicated conversation to have with them, is that even investing or saving for your kids, that's a luxury. Not to say that we shouldn't care about our kids, that's the next leaders of this world. But the reason why I say that is because kids have more working years ahead of them than the parent does. And you can always get a loan for education, but you cannot get a loan for retirement or for someone just to, just pay your bills day-to-day living. So that's why when it comes to the philosophy of just investing, it's always been to make sure that the parent, that individual is taken care of first with their retirement plan before even wanting to invest and save for their kids. So that's just to give you an idea and just to say why extra investments is more of a luxury than it is a necessity. And later on, I'll even talk a little bit more about why that is too. When it comes to the time value of money, I always tell people like, hey, start early, because at the end of the day, we all use that saying that life is short, right? So we know that time speeds up. At least it feels like it does. Like it's about to be Merry Christmas very soon and Happy New Year. And that's why I always tell people that when it comes to you investing inside of your retirement, making sure that you do that early, as soon as possible. Pretty much as soon as you, like, even if you have kids that's growing up, or if you're young and just getting into the work field, start saving now. Because something as simple as the rule of 72, which is basically how long does it take to double your money? And you think about taking the number 72 and dividing it by what the average rate of return is. And generally speaking, the market returns is anywhere from like 5 to 7%. Most people use about 7 to go off of. So if you're taking like 72 divided by 7, that's roughly about like 10 years that it takes to double money. And that just to give you an idea of how much just the wealth building picture is a marathon as well. Same way as life is, but definitely it's a journey that we should enjoy, because I mean, right now we are in an age of information, and yeah, of course there's bad information, there's good information out there. So we have to filter it all. But at the same time, there are so many different connections based on the school that we attend, based on Investopedia, which is a great source. And then just different podcasts is out there talking of other financial advisors or even other people who have built their wealth. They always talk about like just starting early, making sure that you have a good head start. Always talk about just making sure that you use your resources and not try to do it alone. There's strength in numbers. There's strength in numbers. So always remember that. Whenever don't know something, jump online. I would definitely make sure I provide my contact information. I look at it as that we're all family, especially coming from Governor State. So the time value of money is really important. I can't tell you how many people that I have worked with in the past where they say, hey, all of this makes sense. This is really great. And I know I should be doing this, but not right now. As a financial advisor, that is annoying to hear. But after so long, I am okay and at peace when someone says that, because the moment that I take their financial plan more serious than they do, we're not a good fit for one another. Overall, as a client versus to the professional, it's just that we're not a good fit, because there will always be things that comes up. Like there would never be a perfect time to save. Like they always say, there's no better time than the present, because we may be trying to buy a house, we may be trying to pay off this bill, we may be trying to do this and that, but at the same time there will always be something that comes up that will make us feel like, hey, we can't save and maybe we should do it another time. So never let anything get in your way when it comes to doing that, because overall, just to build your wealth is truly a marathon. It truly is. I know that I kind of jumped on this a little bit, talking about some of the tools and the ways to start building the wealth, but just to backtrack a little bit. So my philosophy and what I have been going by for so many years now, especially when understanding how money works, is first thing first, we should start off with risk management. And the reason why I say risk management is because when you think about building wealth, think about it like building a house. The way that you make sure that that house doesn't fall over when you have all these bricks on top of one another is simply by making sure that we have a great foundation. And that's why I always say that risk management is first. And because risk management will be our foundation to protect everything that's important to us in our life. Finance now is basically almost like a new form of cancer, just because of the financial stress that it can bring on people. Everything from the financial stress that it brings on the individual just affording their bills, even as a single individual, also to the stress that they may have just to provide for their family or to give their family the options that they want to give, extracurricularly into school for kids and so on, and then vacations and things like that. But at the end of the day, finance has been stressed for people. So that's why it's always important to make sure that you're protecting any risk that may be unforeseen or that may possibly come up. And some of the things that's in the area of risk management is protecting your income. A lot of times people overlook protecting your income. And believe it or not, your employer helps you do that. That's how important it is. Protecting your income means that, Lord forbid, if anything happens to you where you have to be off from work, will you still get paid as if you're still working? Would your company still pay you either 100% if you have to take off from work about a couple of weeks or so? And would they still pay you just as much if you had to be out of work for about 2 years? In our country, the number one reason for bankruptcies, foreclosures, and things like that is just because of temporary disabilities that last between the months of 18 months all the way to 36. So it's really important just to, one, making sure that you're protecting your income, right? One of the reasons we on this call is just to talk about money and just some other different literacy about it. So we must make sure that we protect that. Another piece of risk management is just making sure that when it comes to your investments, that you're taking on the right amount of risk. And what does it mean to take on the right amount of risk inside of an investment? So based on your age, how risky should you be as far as taking on certain stocks? If we know that as we invest our money, that at any time we can hit a recession, we can hit a depression, and all that money is no more. So making sure we're taking on the right amount of risk inside of that investment. And then another piece is making sure that we protect the inevitable. So I always crack a joke. No one makes it out of here alive. All right. So, but Lord forbid if it was to happen premature, do we have any loved ones, any family members that we care about that we just want to make sure that life is a little bit more financially easier for them? So life insurance, making sure that we have that. And then from there, the second stage is wealth accumulation, because after we have addressed all the risks that may approach us or that may come our way, then from there we can go ahead and start building the walls in that house the way that we want it to be. And in the areas of wealth accumulation, that's when we're looking at, hey, we know that we don't want to work forever. So do we have the proper type of retirement plan in place? Are we saving the right percentage inside of our 401k just to make sure that we can have the right amount of income when we want to retire? Where I always feel that it's important for a person to do a retirement analysis at some point in their life, because yeah, you could be saving 5%. Yeah, you could be saving 10% inside of a 401k and doing all these other things. But if you know that, hey, when you retire, if you want to have $100,000, just round figures, or if you want to have $100,000 of income but travel every single year, then how much would that take? How much money would you need in retirement? How much should you be saving now to make sure that you can have the life that you want in the future? So that's always important to have some sense of understanding around that and some type of retirement analysis. And then from there, wealth accumulation also includes tax diversification. We know, generally speaking, that if taxes is going to go up, a lot of money been printed last year and things has just been coming out the blue. How are we going to make up for that? The working class makes up for that. Raise taxes on us. So as they raise taxes, that takes away from our wealth building picture, our wealth accumulation phase. So it's important that we put some type of tools in place now and save early to make sure that when the taxes does go up, that we're not affected by it and that it doesn't affect our, not even our retirement plan. And then great question right there, where I want to touch on real quick of investing versus paying off debt. It always depends on your opportunity cost. And what I mean by that, where if a credit card is about 22%, let's just say, and then what you want to invest in is only going to give you about 7% or 10%, then it's actually best that we pay off the debt first, because that interest rate is just charging us way too much to borrow that money than us taking that money and investing it somewhere else that's not even paying us the same amount of money that is charging us to pay for that debt. And then, of course, there's always different philosophies that people say, hey, don't invest anything until you pay off your debt. Like, don't invest anything until you pay off your debt. I don't necessarily go that route because sometimes you may have smart debt. And what I mean by smart debt is, believe it or not, we all hate it, student loans. But student loans is smart debt just because it's an investment into your skill set. And then smart debt is also real estate, because that's something that over time is going to, one, can pay for itself. Two, it's going to inflate with with just inflation overall, and then it's an actual tangible item. So I hope that right there answered the question. Then we can also talk a little bit more later on too. And then with the wealth accumulation phase, outside of looking at, hey, making sure that we have a tax diversification plan, then from there, if we know that we have looked at the risk of everything that we could be facing financially, and then if we know that we also have taken care of our retirement plan and emergency money, then let's also make sure then from there we have more money left over. Then now we can start planning for the family if we want to put extra things in there for the kids as well. And then the last cornerstone is wealth preservation and distribution. That part a lot of times is forgotten about. And to be honest with you, I wouldn't say that one part is necessarily more important than the other, depending on the situation that it is. But wealth preservation and distribution is highly important too, because it's just like climbing Mount Everest when it comes to like a retirement plan, where a lot of the injuries doesn't happen on the way up, it happens on the way down. And the reason why is because a person doesn't have the proper plan to make sure that they're paying themselves the right amount of money when they're retired. Because if they're taking out too much money, then what happens is they won't have enough. They're going to outlive their funds, because the goal is to make sure that you can comfortably retire and stay comfortably retired and not have to come out of it. And then making sure that your money outlives you. So then that way you have generational income to pass down. And that's why preserving your wealth and making sure that you have a distribution plan, just even to pay yourself in retirement, is highly important. That's highly important just because of the volatility that we have, where for the most part, most people, they have checking, savings, and then from there, they have a 401k or retirement of some sort. And they have nothing in the middle. So it's like a wide spectrum, right? Where your checking and savings is all safe money. And then you have your retirement account that's investing, that is money that is at risk. So you have nothing in the middle to kind of help you or hedge during the ups and downs of the market. And there's different strategies within investing. So like tactical investing that a person can do, where every day that's buying and trading different stocks. But if you're a person that has 1, 2, 3 different incomes coming in, also have a family, then it's like, how can you necessarily, be as efficient timing the market all the time? And that's why it's always important to make sure that you have a distribution plan as well, because even as you get older, the market will still be ups and downs, especially if you choose to keep your money invested while you're retired, which the philosophy is that when you're retired, it's still good for you to keep part of your money invested. And the reason why is just so it can continue to get the growth overall. Another thing, just some items, and I like to talk about like items to invest in that sometimes we know about but may not be as cliche. So we already talked about the savings account. I would say that right there is a must, even though it doesn't pay interest. It's just that we have emergency fund. Your 401k, it's important to know what type of 401ks that your company have, because a 401k is basically it's a form of an IRA, so individual retirement account. And with individual retirement accounts, we also need to know how are we investing inside of those accounts. And what I mean by that is so I got a question from Colton. Do you do any work? No, not with building credit. Basically, I have resources that I refer people to help them like rebuild the credit. If credit is something that a person is trying to get started with and don't have any credit, one good thing to do is look into secured credit cards or any type of secured loans. Capital One is a great company to start off with secured credit cards. You can, a lot of times they'll let you start off with about like $500 that you give them. And then they give you a certain percentage, anywhere from like, depends on the credit at that point, but anywhere from like 65, to about 80% of whatever you gave them. And then, so say, if it's like $500 you give them, they give you about like $350, just say, for your user credit limit. You keep using that credit card, paying it off. And then your credit start building. Keep the credit card open up until you get an unsecured credit card, which to get an unsecured credit card, one of the easiest places to do that with is your bank that you're banking with, as far as like where your direct deposit and everything is going into. Because with your direct deposit, the bank is seeing your direct deposit coming in, and it's seeing your spending habits, and it's seeing how much money that you even save on your own. So that would make them feel confident in lending you their money. So that's another solid way of building credit. Another thing too is if you have anyone who is open and comfortable with putting you on their credit card, you don't even have to use it. Just having them put you on there as another owner. And you have to be mindful of how that works out too, because some companies, they will let you put a authorized user on your credit card, where say if I have a credit card and I say, hey, Colton, I want to help you out. I put you on there as an authorized user, but that doesn't mean that it will help you build your credit, because some companies don't ask for the social or anything of the authorized user information outside of their first and last name and like their birthday. So if you're going that route, you just want to make sure that company looks at it as another owner that is going to build credit history as well. So that's a solid way to. And I know some people, they go out, buy a car and start building their credit that way. But then the thing is, of course, that car may have a very high interest rate. And if so, then after then about 3 to 6 months, if you do go that route, refinance the vehicle to get a lower interest rate. So that was a really solid question too. And then at the end, if anyone has any questions as far as like other avenues within finance, please don't hesitate to ask me. Because as far as the most part, what I really help and advise people on is building their wealth. I do help them out with other avenues around, because I used to be a business banker and do different things within the industry. But as far as like where my core is just around the different tools of investing and such. But definitely all questions are welcome.
I'm sorry. Somebody else typed in the question. I just have a question about 401k.
Yeah.
If, let's say, for example, you're planning on leaving your company and your 401k, of course, is with your current company, do you think that it's best to, one, I know you were saying the best route is to get it through your employer, but if you're planning on leaving, is it best to then transition to maybe a private or your personal bank 401k savings, or to transfer it to your new employer if you're planning on, leaving? Just kind of how to transition 401ks if you're planning on moving to a new company.
Okay, great question there, Dominique. So with the 401ks, few things. Even if you do leave the employer, you can still save with them, because once you do leave the employer, you can transfer it to your new one and just pick it back up right there with the new employer. Or you can, the money, if you do leave one employer, you can take it, roll it over to your bank, or another advisor of some sort that would help you manage that group of money, and then just start a new 401k where your company is at. I would say still stick with your employer up until you leave them, because one, you get in a match. If you go to your bank and just do it on your own, you don't get a match. And then through your 401k, a person can always contribute more money than what they can if they start one on their own.
Okay, thank you for that.
Yep, absolutely. And then as far as Giovanna, what are some of the best resources for beginners to learn stock and investing? There's different podcasts that teaches you about like stock trading 101. The biggest thing about when it comes to learning about stocks or investing. So me personally, I don't like to invest into individual stocks. It's just way too risky. There are individual stocks that I own, but I don't like to look for them and invest into them. I personally prefer a mutual fund or some sort of an ETF, because that's giving me, one, more protection. Two, is also allowing me to not have to look at it as often. And it's just giving more diverse. And that's why that is more protection, because in a mutual fund or ETF, you have multiple different sectors. So think about that like going to a Walmart and you literally have food, you have clothing, you have beauty products. And then from there, you have all these companies within this big fund, and that's constantly trading these different type of stocks based on the different sectors and the companies that they're in. So you don't have to be an expert just on one stock. So, I mean, especially for beginners, I would definitely say, look at that route versus the individual stock picking. There are different podcasts and classes that a person takes. David said, what are the percentages to contribute to a 401k? Always start off at least with your company's match. And when you start off with your company's match, that at least gets you started on the right foot there. From there, in order to get that exact amount that you should be contributing, it's best to do a retirement analysis based on what your long-term goals are for yourself when it comes to retirement. Because if you say, hey, I want to live off of $100,000 of income, even though your employer may be matching you 5%, you may have to do, 8% just to get up to that 100,000 a year when you retire. Another thing to keep in mind about 401k is the different type of 401ks, which is traditional 401k as well as Roth 401k. It's the same thing as traditional IRA and Roth IRA. The big differences about that is traditional, those are pre-tax dollars that you're contributing. And then Roth is after-tax dollars that you're contributing. So in other words, think about it like this, because it's about taxes. And that's why I say tax diversification is important. Because when it comes to a traditional 401k or a traditional IRA, you are choosing to not pay the taxes on the seed, which is the smaller amount. So then you would pay taxes on the harvest, which is the larger amount. And then with the Roth account, you're deciding to pay taxes on your seed, which is the smaller amount. So you don't have to pay taxes on your harvest. So you just allowing yourself to have more money in the long run, not paying taxes up front because you know what they are versus chancing to see what they may be later on. Keisha, when refinancing your vehicle, does it add one more month to your loan amount that is due, or does it just lower the interest rate? and keep the remaining months, does it lower? So that just all depends on the bank that you're going through. And that's why I always tell people, when you do refinance a vehicle or refinance anything, look at the new term that is going to be. Sometimes you can pick up the exact same term, Keish, or where you're coming from. So if you got like 3 years left, you can leave off at 3 years left, but it may not change your payments necessarily because your term hasn't changed. Or your payments could change just based on where you're at with that interest rate. So a few things can happen when you refinance. Either one, you can end up paying more for that actual item, but saving month to month and saving on interest. Two, you could just overall be paying the same amount of money that you have been, but you have a lower interest rate, you got the same term. So you may be finished with that loan much sooner than expected. Or three, you got a lower interest rate, but you just had to start over. So long term, you may pay a little bit more for the vehicle, but at the same time too, though, you got the lower payments month to month. If that answers your question. If not, definitely just unmute or just type something in. And then for Stephen, being that you're connected to a large financial institution, can you inform us on the amount of emphasis that is being placed on cryptocurrency investment for individuals and institutions? So with the institutions, they do feel that it's going to be around to stay. As far as how it's going to be regulated for them to accept it, that's what they're unsure of. So not too much, don't know exactly what's going to happen. I feel like it's going to be around. As far as which coin, which platform going to be, that is unsure of. But if you ask me, I kind of think that the institutions invest into it themselves. And then if you leave a company to start your own business, how do you transition your 401k? Should it be with your own bank, like you stated earlier, and is a 403 plan similar to a 401k? So yes, a 403b plan is similar to a 401k. That just means that it's a different type of entity that you work for. So 403bs is typically for like non-for-profits and private entities like schools and things like that. And 401k is for profit companies. So, if you work for a bank or, like any other employer that's for profit. There's also things called 457s, which is another retirement plan, but that's just for like police and firefighters and things like that. And then if you're starting your own business and you're transitioning with your 401k, so with your 401k, you can either roll it over to your bank, and which, by the way, there's financial advisors that works for banks. There's financial advisors that works for just financial firms. There's financial advisors that work just for investment firms. So overall, with your 401k, if you take that 401k, as long as you're with the financial advisor, if you feel comfortable having with your bank, that's completely fine. They're going to just sit you down with the financial advisor, and then they're going to roll it over into another account. And that other account may be a traditional IRA. That other account, if you're a business owner, they may recommend you to put into a SEP IRA. And then the SEP IRA is nothing different from, it's like a traditional IRA, but because you're a business owner, it gives you tax write-offs when you make the contributions to there. So that's something to definitely talk with an accountant about, as far as the tax write-offs that you can use being a business owner contributing to retirement, because you can't use it as a write-off. The only thing is that you'll pay taxes on it later. And then who we have, Christina. When you mentioned you should keep the money invested when you retire so it can keep growing, what is the alternative? Keep it in an account, but just move it into a less risky profile and retire. So yeah, so when you retire, some people keep a little bit invested still because they want it to continue to grow. Now, if a person is investing their dollars, then to keep in mind to have at least 2 years, if not 3, of their yearly retirement income. And the reason for that is because the market will go down while they are retired. And the moment that the market goes down, we don't want to have to pull money out of that account if it's down. Because the moment we pull money out of an account while the investment is down, it's going to take us twice as much work to gain back what we lost. So that's why using different things of safer alternatives. Safer alternatives could be just investing in bonds. Safer alternatives could be just investing into income stock. Safer alternatives, and which is actually one of my favorites, is life insurance, whole life insurance. And then also other alternatives can be real estate, but sometimes real estate and the stock market kind of correlates with one another, just based on what's going on in the economy. Another thing that some people move their 401k and retirement to is annuities, which is an annuity is a life insurance product as well. And an annuity is something that there's absolutely no risk involved. It's just that you decide to take this lump sum of money, you give it to the insurance company to borrow it for a time period, and they promise you a fixed rate of return every single year. It's just your fixed rate of return is low. Sometimes it's not even keeping up with inflation. Keep in mind that inflation grows about 3% conservatively every year. So if you're not getting a rate of return that's giving you at least what inflation is, then sometimes, either you just right above water, or you may be wasting your time with doing that. So always look for something that's about 3% or more, because inflation is about 2.5 or like 2.59 or something like that. So roughly about 3%. Colton, what budgeting advice would you give to individuals or families that may be stuck in a 0.95, 5.95 or similar lifestyle where your living expenses prevent from you being able to invest? First thing first is to make some sacrifices. Those are conversations that I have to have with clients at times, where just kind of like we may have to take a look at, hey, what is leisure? So, if that's eating out, I one time looked at my own monthly budget and I was like, wow, I spent about $400 just on eating out. And then another about, $300 something on groceries. That's like $700 on food. So sometimes it is just that. Sometimes it's just that, at times we have seen or heard of like things could have changed. We could have at one point been making a lot of money here, and then something changed, so that means that we have to change our lifestyle. Another thing is that I always tell people, even when you do start making a lot of money, still live like you don't for a moment, just to continue to build that discipline. Because anything in life, look at it like BOR, boundaries, order, and structure. No, did I say that? BOS, boundary, order, and structure. Where basically, if you're making more, start saving more and start investing more. So then later on, you can start spending more. Because otherwise, that just, really put a person in a tight bind. And then I say that even when it is tough for you to save, still save. I remember at moments, especially when I started my business, my income drastically changed. And I still challenge myself to save what I was saving for retirement, and then also too in other avenues where I was like, hey, let me still aim for the 20%. If you fall short of that, just do your best to make it up. Otherwise, it's a marathon, and you'd be surprised your life can change in 90 days. And then what is the best practice for tackling student loans and credit card debt? So for student loans, I always say first get a consultation on your student loans. What I mean by consultation is like GradFin is a good company that does like consultations for students. SoFi is a good company. And the reason why I say do a consultation, is to one, see if any of the student loans can be forgiven based on your career field that you may be in, or see if any of them can be refinanced if it's private. And then also two, outside of that, what I always tell the people, if your student loans is that big and it's just taking time to really attack it, what I do is, and I have done this for clients in the past, is satisfy them and then build a long-term plan to pay them off. There's clients that I've helped that satisfied their student loans, and we built plans and put things in place that maybe about 10 years out, they'd be able to pay off their student loans in full, versus them having to continue to pay their student loans in about, like 15 or 20 years. So sometimes that may be a strategy where it's like satisfy it now, make a plan to pay it off long term with the lump sum of money that you're investing, or something that you're monthly investing towards.
All right, and then I have two sets of questions. The first
Mhm.
one's, you just mentioned about insurance. I was actually going to ask you a question. So, between choosing the best insurance, I've kind of heard different advice. So the term and then whole, and then some people that do term because it's cheaper, and then transition to whole as you get older, which I'm aware that it gets more expensive to with whole the older that you are. Do you just always just recommend just whole, or what is your input on transitioning from a term insurance policy to a whole life insurance policy?
Yeah, great question there. Most of my clients have both. Even myself, I have both.
Mhm.
And this is the reason why, because yeah, you may have to start with term. And if so, that's completely fine. Because with term insurance, it's like you're getting this amount of death benefit for this amount of money. So you get a lot of death benefit for very cheap. So that's why with risk management, everyone should have life insurance. Like everyone. If you have life, you should have life insurance, because I'm 9 times out of 10, I'm pretty sure you have it on your phone, pretty sure you have it on some type of other electronic device. We have it on our card by law, but put it on your life, because your family would definitely thank you, especially anything premature. From there, converting to whole life, even though yes, it is more expensive because life insurance is age and health sensitive. So the earlier that you get it, the cheaper it is for you. But if you can't afford it, starting off with term at least locks in your health rating. And you want to make sure that you're with a good company that you're going to stay with. And the reason why I say it locks in your health rating is this, because generally speaking, as people get older, their health doesn't get better. And as long as you have term insurance with the company, they will let you convert it to be whole life so it never expires. Even if you live to be 100 years old, even if you end up having diabetes, heart problems, or any other health issues, they still would not deny you of having whole life insurance, meaning just having it for the rest of your life.
Okay.
Um, Now, the reason why, if you're strategic about whole life insurance can be an asset for you that works similar like real estate, and actually a little bit better. Um, Life insurance can hedge your investments, meaning that when the market goes down, your life insurance can protect your investments. Um, I mean, different things like Disney World was built off of life insurance. Walt Disney couldn't get a loan from anybody. They wouldn't let him borrow no money to get that place started. He just went to his life insurance, took the money from himself to start it. A lot of real estate investors, they don't go to banks to flip their deals or to get the cash out. They get it from their life insurance, and then they put the money right back. So life insurance, you can put yourself in position to be your own bank in a lot of different ways. So it's a powerful tool when you know how to use it.
And then
Uh,
my second, I'm sorry, because I had
no,
a
you're fine.
second part. This a second part to the question that I just had. Would you recommend, of course, it's another benefit from an employer, but again, if you are planning on, move to a different company, is it best to get a private? I know you can save more by getting it through your employer, and then they give you the option if you leave to continue with them, but the pricing go up. Would you recommend getting private life insurance, or just keeping it through your employer as long as it's a benefit option?
Yeah, I would definitely say get your own life insurance, and then your companies usually give one time your salary for free. And then sometimes it may, if different position may be, up to 5 times your salary for free and all these other things. But it's definitely important for you to have your own when you leave. And the only reason why, because there will be one day you want to retire and not work, and you may still want life insurance. And then also too, you don't want companies to change the type of policy that you have based on what they're willing to pay for. Because they may be giving you a good basic term life insurance policy now, but then because budget may get tight for them, or they're looking ways to cut budget, then they may change your life insurance policy and may not be what's needed to protect your family. So I
Okay.
always say definitely get what you need on the outside for sure. And then Matthew, that was a great question there, because whole life, like I said, is just something that sticks around with you for the rest of your life. So even if you live beyond what the term is, some terms is a 10-year, 20-year, and some terms last to like 60 or 80, right? But the thing is, if you live to be 81, then you no longer have it. And then if you're 81 and need life insurance, there probably not, won't be a company that will insure you. So that's one reason to have some form of whole life insurance. I always say at least have the minimum amount of whole life insurance, which is roughly about $50,000, just based on burial costs and final expenses and how inflation works out. At first, it used to be 25,000. Now it's looking at to being pushed to 50,000. At least have that in whole life. And then people say buy term and invest the difference, but a lot of people don't know what to invest the difference is. And a lot of people actually spend the difference and not invest it. So if you could save money inside of a whole life policy, which is a saving strategy that never goes backwards, no matter what the market does, as long as you structure that life insurance policy right, you could never lose money in there long term. And then you have an investment that's doing really well, but it's ups and downs. And now you got something that never goes down. Now you got something that's doing like this. So you have your investments and life insurance work together when you structure them properly. When taking money out of life insurance, how long do you have to have it? Whatever is available. I always tell people wait about 10 plus years out to take money out, because generally speaking, 10 plus years is the time frame when your life insurance is more beneficial for you to take money out of. 10 plus years, it sounds long, but it's really not, because generally speaking, real estate is more of a liability in the front end, and it doesn't become an asset until 10 plus years out. So that's why life insurance is compared to like real estate, because they both are two assets that is on your balance sheet. When a person look at your balance sheet, they ask you about your life insurance. Term life insurance is not an asset just because it needs to be there if you pass away. But if you have whole life insurance, banks will actually give you their money by putting a lien on your life insurance. The same way they give you their money, putting a lien on your property, again, a home equity line of credit. So it just depends if the money is available and if you have it to take it out. But the longer that you wait, you don't even have to pay it back either, depending on the type of policy it is. But you know, it just all depends on how it's structured. Do you think Social Security will be able to pay out benefits in the future, or should we not really rely on it at all for retirement? Yeah, we shouldn't rely on it. I do think it's going to be around. It's just going to keep getting smaller and smaller. I know I just seen a report that said by 2034 there will be no life insurance. I mean, no Social Security. I don't believe that. Even reading a book back in like some years ago, I remember reading that Social Security was never really meant to retire people. It was meant for people to have a pool of money to pay into, to then think it's for us, but it's actually for the government to pay other people and pay other bills. So it can kind of be, you know, it depends on how you feel about it. But at the end of the day, I don't think it's really set for our retirement. And then as we approach one here, and I'm going to cut off your questions after what is being asked, submitted to the curious. Yep, cool. So yeah, if you guys have any other questions, Colton, if I can give you my information, then that way you can put out an email, share with everyone. More than happy to do so with that.
Absolutely. Yeah, we can have, if you want to email me your contact information, and then if you all want to email me, all students or attendees in the chat. Okay, there's my student email for you all. Like I said, we were recording, so I will, given no tech issues, because those happen sometimes, given no tech issues, we will have the recording to distribute. So we definitely want to be cognizant of your time. We appreciate it. We started this pretty much right at noon, so we had a really, really awesome hour-long conversation. We really thank you so much, Terrence, for the incredible information you have been able to give to us here today.
Absolutely. I hope it was helpful. I know we kind of jumped around a little bit, but I like the jumping around because I feel like it's more engaging and not just like, just talking at you, but we're talking together. So definitely appreciated this, you guys. I had fun.
Absolutely. And again, thank you to everyone on the accounting, finance, economics team that helped put this all together. And you all have a wonderful rest of your day. Again, reach out to me if you'd like Terrence's information. He did put it in the chat if you need it after the fact. So thank you all again.
Terrence, thank you. Very useful
Absolutely.
information.
You guys have a great one.
Thank you.